So I want to thank everybody for logging in here today. Listen to our webinar. We have a guest speaker going to talk about real estate trends for 2020. We have Neil Bawa who is going to join us in just a few moments and talk about kind of his outlook, his perspectives looking at 2020 and the year ahead. And Neil did a similar thing for us last year in 2019, so we're happy to have him back as well to certainly share his thoughts. Neil is an expert in the field, and especially multifamily investing, but obviously, as you'll see in his presentation here in a few minutes, also gives us just some great information for the general real estate market as well. So again, we're happy to have him back today. But just want to introduce myself here and go through just a few things. Scott Maurer, I'm the Director of Business Development here for Advanta IRA. I've been with the company for a number of years, oversee the business development really in our Atlanta and our Tampa office, and certainly across the country with all the clients that we work with. My contact information is here. I'll put it up again at the end of the presentation. So if you have any questions kind of about Advanta or about self-directed IRAs, I'm happy to address those, maybe towards the end of the presentation too. So just as we go through the presentation today, anyone who's listening live to the presentation or watching, please, there's a question box on your screen. Type any questions you have either for myself or for Neil. We'll make sure that we get those answered as well for everyone who's participating. So please use that question box. If you're listening to the recorded version, again, my contact information is on this slide, and certainly Neil is going to share his as well during his presentation. Just a quick disclaimer, anytime we do a webinar or a live lunch seminar, just note that Advanta IRA does not provide any legal, tax, or investment advice, and we do not endorse any products and are really not affiliated with any other company, including any companies or individuals that are our guest presenters. We like to bring in different experts to share their views and their information, but it does not constitute an endorsement of them or those views. So we provide the information for educational purposes, but always consult with your attorneys, accountants, other advisors before entering into any particular type of investment. For those of you who may be unfamiliar with Advanta IRA, just a little bit about our company. We've been around for over 15 years. We have over $1.2 billion in assets under management, over more than 7,000 active accounts between our Tampa and Atlanta office. And like I said, we do work with people all over the country. We really focus on two things at Advanta for our clients. One is our customer service and the concierge level service that we give to all of our clients in appointing them to a specific account manager here at Advanta. And we also focus a lot on the education. And today's event is just simply an extension of that and a continuation of what we've done over the last several years. Again, bringing information not only on self-directed IRA accounts and going the ins and outs and of what we do and what's allowed and what's not allowed under IRS rules, but again, bringing in other experts, attorneys, CPAs. We've had property managers on. Obviously, we have Neil on today to talk about multifamily investing and his outlook for 2020. So that's really our commitment to our clients, is giving them that level of customer service and also them giving them a lot of knowledge about self-directed IRA accounts. One of the reasons we see self-directed IRAs used so often, especially for people who are raising capital, one, you get a lot of repeat investors, people who already invest with you or looking to invest with you, just simply using their IRA account to make a further investment. Or for people who are doing their own self-direction for their own assets, it's simply using a different bag of money for that next real estate deal that you have. A lot of people are not expecting to touch their money until they're retired, and that may be 5, 10, 20 years from now. So putting money into these types of illiquid investments is fine, because they're not expecting to draw from this money anyway for a number of years. So if the investment has a 3, 5, 10-year payouts, it's not going to affect them at all, because they're not looking to access that money anyway. And certainly individuals who are self-directing not only are getting into tangible assets, hopefully they're also getting better returns and having their money sit in a money market account, or having your money ride the stock market wave. And that's something that keeps some people up at night, worrying about when the next shoe is going to drop, overseas or maybe even domestically, that's going to impact their IRA, their 401k account. So self-directing allows you to use your IRA funds into these different real estate investments and have a lot more control over it. In fact, there is no outside approval needed. If it's your account, you make the decision overall on what you want to invest in using your IRA account. As far as self-directing, that can involve any type of IRA account, traditional Roth, SEP simples, and certainly any former 401ks, 403b plans. We also offer solo 401ks, also some people call them QRPs. Those are certainly things that we offer here at Advanta as well. And obviously the assets that you can purchase, any type of real estate, private notes, mortgages, private placements, multifamily syndication. The list really does go on and on. So I didn't want to take up too much time today with just going over just some of those basics on Advanta in case anyone was unfamiliar with us. Go to our website, advantaira.com, go to our YouTube page to learn more about self-directing specifically. But what I wanted to do is really allow for the most amount of time for our guest presenter today, Neal Bawa, who's with Grow Capitus. And Neal, I'm going to nominate you here to a presenter so that you can share your screen. So
yep.
you just click there to accept it. If you go up to the sharing button, there's a spot you can share your slides. And I'll,
okay.
but Neal, yep, I can see your computer now. So we'll have your slides up here in just a minute. Looked like it went
Perfect.
away. Oh, there we go. So again, and before Neal starts, I'll just invite anyone again, if you have questions as we go along, type them into the question box on the screen, again, whether it's for myself or Neal. We'll make sure to get those answered. But at this point, Neal, I'm going to turn it over to you.
Thank you so much, Scott. I'm glad to be back, here on Advanta's podcast. And yeah, this is actually one of my favorite presentations. I just finished writing the 2020 real estate trends presentation, so you're in for a treat. So I'll start off with a super quick intro about me. I am the founder and CEO of two companies, so that's Grow Capitus and Multifamily University. And I manage about $300 million worth of real estate for over 500 investors. I am super passionate about real estate investing, and I travel throughout the country talking about data-driven and analytics-driven real estate investing. And I also talk about how apartments are a great asset class for long-term wealth building. And doing these kinds of deep dive real estate trends webinar is something I really, really enjoy. So here's a quick slide about a sampling of my portfolio. We added $187 million worth of assets to our portfolio in 2019. Over 400 investors, 350 investors invested. Multifamily, student housing, public storage, and glamping resorts are all part of our portfolio, though multifamily or apartments are really the biggest chunk. And we intend to add over $200 million to our portfolio in the coming year. And I would guess that about 2/3 of those would still be apartments. We do both existing apartments like Chelsea Place here and Park Canyon here. And we also build apartments like Coyote Creek, Rails on Main, Falls at Christmas Common, Art City, and The Grid. These are all properties that we're building from scratch. So I enjoy having my feet in both of those worlds. Okay, let's look at the agenda. I always start with the economy, jobs and inflation and consumer spending and recession fears, because all of that stuff is going to drive real estate demand and supply, which is going to drive your profits if you're investing in real estate. Then let's talk about interest rates and their impact. And then I'm going to segue into a new segment that I wrote for this year, which is called Landlords Under Attack. We're also going to talk about the single family forecast for 2020, and then we're going to follow up with the multifamily forecast for 2020. And then I'm going to jump into a short section that I call the story of apartments. It's a fascinating look at the apartment market and how it's evolved in the US over the last 15 years. I finish off with the most popular section of my presentation, which is the shootout. Shootouts for single family, multifamily, and new construction. We talk about the best cities and states in the US for investing in real estate in 2020. The final couple of slides are dedicated to my personal picks. So I pick one national city and one underperforming city, that both of which should do really, really well in 2020 for real estate investments. Before we get to the awesome stuff, here's the really boring stuff that my lawyer forces upon you. This is an educational webinar. It doesn't squeeze out the risk in real estate investing. My recommendations are not magic. They're personal opinions. Do your own due diligence, consult professionals, and understand that even if you do all of those things, you could still lose money. Bottom line, real estate is an at-risk investment. Oh, and feel free to type in your questions. I'll take questions at the end. Scott might, throw some questions at me. So I'll actually like answering questions as I go. Okay. Let's go. Any story of real estate trends has to start with the economy. Without a strong economy supporting real estate, all of these forecasts are practically worthless. So before we jump into the nitty-gritty of 2020 real estate, let's spend a few minutes at the 30,000-foot level. This is important stuff, people, and it really, really affects your real estate returns. So let's look at consumer spending, inflation, job growth, and recession fears. So the first thing to know about 2019, and we're going to do a quick review, is this is now the longest expansion in American history, 126 months, and still going like the Energizer Bunny. Now, demand is also strong, and the biggest reason for that is, well, lowest unemployment rate in 50 years, and 3 rate cuts in 2019. Those make for a yummy economic cocktail. Also, some of the headwinds from last year have abated, especially the big one with the trade war. So our key theme for 2020 is this: a recession is much less likely than it was 12 months ago. An economic slowdown is much more likely. Let's figure out why. Well, if you're thinking, Neil, you just said this expansion's getting long in the tooth, right? 10 years and counting. Doesn't that make a recession more likely in 2020? Well, maybe. I have a chart to counter that argument, my friend. So on the left, you see confirmation at the very top, a blue bar, that this is the longest cycle that we've had, the longest expansion ever, right? But here's something that's more important. On the right side, we're looking at actual growth. Well, this cycle doesn't look very impressive at all. You see it up here in green, right? So we've just had 26% growth in this cycle. Well, past cycles have had a ton more growth before expansion fizzles out. For example, look at this one with 54% growth, this one at 43% more growth. So a lot of economists are now saying that we might actually be only half or 2/3 of the way through. I don't know what to believe. All I can say is that 2020 at this point does not look like a likely contender for a recession. And as soon as I say that, a bunch of you will point out to me that, Neil, were you under a rock somewhere? The yield curve inverted in 2019, and that means recession. Yes, sir. Well, I get to tell all of you economic geniuses 2 facts. First, we've had 2 recessions without yield curve inversion. Second, we've had false positives twice. So while the yield curve thingy is a very important data point, it's not a commandment from the Almighty. Also, what's more important now is the Fed actually pays very close attention to the yield curve. And as you can see, is taking measures way more aggressively after inversion than they've done in past years. So maybe they did enough to prevent one? Who knows? We certainly got some smart people who agree with my feedback. Here's Spencer Levy from CBRE, and he feels that the Fed did do enough, at least to push the recession back to 2021. But if you stare at the blue box or the blue text on the screen, he is still predicting a slowdown in 2020. But you might say that, in that Darth Vader voice of yours, Neil, you're a perma bull, right? Well, I know that there'll be a recession in 2020. Even though I'm all knowing, I still need you to tell me what happens in real estate if there's a recession. Okay, let's see if we can get audio and see if what the impact of that recession will be on real estate. I'm going to see if I can share my audio, not just my my video. Okay, all right. I haven't done this for a while in, let's see. Let's try this. So Scott, I want you to tell me if you can hear the audio, okay? All right, here we go.
Yeah. Okay.
How's the audio? Coming
Yeah, I
through?
can hear it. It's a little light, but yes, maybe start it over. We can get it going.
Yeah.
Fairly mild economic slowdown on the horizon. In that case, we'll probably see the housing market perform quite well, although not as well as it does during expansions. With some job losses and some slower income growth, we might see housing slow a bit. With fewer sales, we might see prices slow down. But given that construction has been fairly limited, there are plenty of buyers. Household formation years, we expect that will help keep the housing market on a pretty solid footing, even if we were to see a recession. So we may see home sales slow, we may see price growth slow, but we're unlikely to see broad spread house price declines like we saw in the last recession.
Okay, all right. Hopefully you guys were able to understand that one. Basically, Realtor.com wasn't exactly shaking in fear, right? So sure, if there's a recession, we'll see somewhat of a slowdown. So hopefully now that I've satisfied the perma bears, I can get back to my projection, which is a 2020 slowdown. And we can see that the Federal Reserve of the US actually agrees with me. Here's their projection on consumer spending, slowdown. And then next, here you see their projection for growth, slowdown. And lastly, you see their projection for inflation. As you can see, slow down, muddling through, stuck in traffic, but definitely not going backwards in 2020. And part of the reason that we're not likely to go back is that there is currently a labor shortage in the US. We produced 24 million jobs since the last recession, and that has gotten the unemployment rate down to where even those pesky millennials have jobs. 5 of them even have good jobs, all with Google. And what that means is that we have a labor shortage of over 1 million people in the US at this point. Now, we're not producing new jobs quickly enough to stoke inflation because that can end the party, but we are producing them quickly enough for employers to keep giving our consumers raises, which keeps the party going, though somewhat muted compared to 2019. And though I've already made my point, my graphics designer didn't feel very fulfilled, so she produced this totally unnecessary slide, which shows a very smooth reduction in the unemployment rate over the last 10 years or 9 years, down to 3.5%, which is a 50-year low. But here's some bad news. Unemployment rate goes down, so employers pay more, which means landlords raise rents like crazy, which means that Rentzilla, the rent control demon, has come back to eat us all alive. But I have a separate section on this, so I'm not going to cover it here. I just like the cartoon on the left and the graphic on the right. My graphics team tries to make up for my terrible presentation skills. And finally, there's Trump's trade war. Here's what it looked like in 2019 with Mexico making for such an awesome piñata. And of course, Trump and Lee were engaged in a my gun is bigger than yours face-off in 2019, if you know what I mean. Well, in 2020, things are so much groovier, baby. Mexico and Canada have been beaten and bullied into a new deal. And the Chinese are in love with America again. I mean, they're in love with our money. So bottom line, decent but unsexy growth, inflation under control, tight labor market, trade war somewhat fading. Well, they all mean we might not get a recession and the conditions exist for real estate to do okay in 2020. Not great, not good, but okay. Oh, I'm going to skip past these since I just covered them. One biggie that we haven't covered is interest rates. What's getting all the buzz is President Trump's very public battle with the governors at the Federal Reserve, our central bank. Let's take a look to see if the bully got his way on interest rates. Well, it actually looks like he did. Let's look at the raises over the last year. The Fed did something that none of us thought they would do. They didn't raise rates as we all expected. They actually lowered them, proving all the forecasters, including me, completely wrong. And as you can see, that meant that the mortgage rate actually went down as well, almost in lockstep. So just about 3/4 of a point on the left, just about 3/4 of a point on the right. And that was 2019. So what about 2020? Let's talk about interest rates in 2020. What does Spencer Levy think? Well, Spencer thinks that there's actually going to be more rate cuts coming. So he's predicting 2 more rate cuts in 2020. So we're going to go down to a range of 1 to 1.25% for the federal funds rate. And he believes that's going to be enough to prevent a recession even as growth slows. Let's talk about Fannie Mae. This is the biggest mortgage company in America. Do they agree with Spencer? Yes, they do, because they are predicting the lowest annual average mortgage rates in nearly 50 years. We started keeping track in 1973, and their forecast is we're going to have the lowest rates since 1973, 3.5 to 3.6%. In fact, everyone thinks that interest rates will stay low in 2020. We had trouble finding anyone that thought different. So bottom line, interest rates are a big plus for real estate in 2020. Not only are they helping keep the economy out of a recession, they're also going to directly help the real estate industry. Nice. But if all of you evil landlords out there are smiling at this good news, let me wipe that smile right off your face, because guess who's back? It's Rentzilla, arriving at a city near you. California, check. Oregon, check. New York City, check. Only a nuclear weapon can destroy cities as effectively as rent control can. To stay out of the political debate, we decided to give you a quote from someone that doesn't even live in America. Assar Lindback is a Swedish economist. Let me read the quote for you. Next to bombing, rent control is the most effective techniques so far known to destroying cities. He says it must be right. Those Swedes, they know everything except how to make Ericsson profitable. But that's just one thing. Right, like in the movies, Rentzilla arrived first in the Big Apple and immediately proceeded to make it a smaller, less tasty apple. I'm talking about cap rates, people. Have you been reading about them since they passed rent control in New York? The word slaughter comes to mind when I think about the last 4 months for cap rates in New York. In fact, here's a meme floating around the internet. People are pointing out that Governor Cuomo, who drove the rent control bill, has become U-Haul's salesperson of the year. 76,000 people left New York in 2019. I will bet $100 that that number will be well over 100,000 people in the year 2020. And these politicians did it even though they are fully aware, 100% aware, that Rentzilla reduces housing availability, it harms investors, it turns existing properties into ghettos, increases administrative costs, lowers income and property tax revenue, and creates a barrier to entry for new housing. In fact, the only thing that Rentzilla does really, really well is to get politicians elected. And given how desperate politicians are to get elected, do expect Rentzilla to show up in more Democrat-controlled cities and states really soon. This is why if you look at my 2019 investments, you'll notice a theme. I'm a liberal Californian Democrat that only invests in high-growth Republican states in the Southeast. And why do I do that? Well, take a look at this truly ugly graph. So if a city is above the line, its cap rates are going up, which means its prices are dropping. So did you notice that the bottom half of this graph here are all these jumbo rent-controlled cities that are in this light color? That means that they've got rent control, right? And you notice that all of them have higher cap rates than a year ago, which means all of them have lower prices than they did a year ago, right? So this line would be equilibrium. So if it's above the line, then they've got higher cap rates. And you see all the blockbuster cities, San Francisco, Manhattan, Los Angeles, New York boroughs, San Jose, East Bay, Portland, and you know, DC suburbs, all of them with some form of rent control, all of them with cap rates going up. Whereas the dark orange circles are cities that do not have rent control. And you notice that there's a heck of a lot more of them under the line. Some are over the line, but mostly under the line. So you can see what rent control does. It lowers prices, which I guess is what the politicians think is a good thing, but then it also prevents investors from investing in new homes. This is why rent-controlled cities like San Francisco and Oakland have the highest rents in America. So what does this mean? Well, it means that Rentzilla is now driving investors away from New York and California and other states that are talking about rent control. And where are these investors going? Well, they're going to the Midwest, they're going to the Southeast, and they're going to Texas, the landlord-friendly places, right? Well, Rentzilla owns a lot of property there, so he's unlikely to show up there and wreak havoc. Bottom line, America's politics are splitting the country into two. And if you're a landlord, you better understand which half is better for you. Okay, I'm moving on. Let's put Rentzilla to sleep and give you this single family forecast for 2020. I like the way that these bulbs are set up on screen. Most of the bulbs are off, and then there's a bright one. So that might actually be fairly descriptive of where single family is in 2020. Realtor.com is my first data point. They are not in a bullish mood. Flat home prices, existing home sales down, flattening price growth. That's what you see on this quote. You are no fun, Realtor.com. Do keep in mind, though, that Zillow and Fannie Mae felt that the single family housing could do a little better. They projected price growth of about 3%, where Realtor.com is projecting about 1%. Both of the numbers are fairly unsexy. But why? Why is Realtor.com so bearish when we know that we're not making enough homes? Take a look at this graphic. Every year is the same. Supply is lower, demand is higher. Even in 2008 and 2009. Because population keeps growing, right? So why aren't home prices forecast to increase a lot more? I'll give you another data point that puzzles people. Supply, or inventory, as the hoity-toity call it, is pretty low. In fact, supply is at its lowest since 2015. This is puzzling. Why aren't prices projected to go up a lot if demand is high and supply is low? Well, here's your answer. It's affordability or lack of it. I wanted to call it Affordzilla, but it doesn't really roll off the tongue well. The problem is not demand. It is our inability to pay the prices that exist today. So the only sexy segment in single family right now are the lower end affordable properties in the South and Midwest, especially in both North and South Carolina, Georgia, Florida, some parts of Texas. That's where the demand is strong. And that is where the investors are headed. So except for those affordable southwestern pockets, single family prices are basically predicted to be more or less flat. So Neil, what does that do to rent growth? Well, unfortunately, it's going to go down, but maybe not this year. Here's Zillow's prediction. This is rent growth. So they're predicting rent growth to be around 3% this year. Here's 2020, right? Which is pretty healthy, by the way, before dropping down below 2% next year. So we're expecting a slowdown in home prices this year. We're expecting a slowdown in rents next year. That makes sense to me. And where are these rents growing the fastest? Well, I really hate to brag, but if you're on my social media feed, you couldn't have missed me screaming my lungs out all year about Mesa, Arizona. No, I don't work for the Mesa Economic Development Department. I've been fanatically following the data, and my company, bought land and did our zoning a full year before apartment list down here. In this month, Jan 2020, forecasted Mesa to be 2020's rent growth winner, right? We were there 1 year ago talking about this, buying land, talking about it on social media. So I guess E equals MC square and me equals awesome square. Get it? And here's that property that we're now building in Mesa, Arizona. 240 units with nightly rentals or Airbnb zoning for 40 of the units as a huge bonus. Massive new construction all around us and projected profit numbers that are sweet. You can see them up on the screen here. If we were raising $14.8 million in equity in December, and we now have raised all of it except the last 800K. If you're interested, I'll send you more information about this through chat. All right, I'm going to skip past this slide just to keep the presentation moving smoothly. But many of you investors are not into new construction projects. You want lower risk, you want cash flow. In case you do, check out this public storage project that we're doing in Arkansas. Great numbers, strong cash flow. I'll also send you a link to this one in chat if you're interested. So what's a multifamily guy like me doing in public storage, you might ask? Well, honestly, the best quote that I ever got from a public storage expert was that public storage is an extension of multifamily. Multifamily is a roof over your head for you. Public storage is a roof over the head of your stuff that you cannot fit in your home. So the performance of this asset class has been so much better than every other real estate vertical, including multifamily, that I just cannot ignore it any longer. It's just been a very, very strong performer in the last 15 years. So I'll send you a link to this and you can read more about the public storage market and the benefits there. Anyway, back to the presentation. So remember the affordability issues that we talked about? So now we have this new phenomenon of cheap new homes, or entry-level construction, as the hoity-toity call it. Now, don't expect to see NIMBY places like California or Washington in this list, but Texas and North Carolina and Florida are actually working hard on building entry-level housing. Did you see Boise, Idaho in the chart above? If you saw my presentation at Advanta 1 year ago, I actually picked that as my top pick last year. I also picked it the year before. So it's really nice to see other people figuring it out. Also note that both Charlotte, North Carolina and Raleigh, North Carolina are in this list. So all that affordable housing, this new cheap housing, is making the millennials flee to these cheaper states. If you haven't had your coffee today and still need some coaching, here's an awesome animation for you. Just follow the graphics. Don't pass go, don't collect 200, get on the first plane to the states painted in yellow, and go to the smaller suburban towns near major metros, like Mesa, Arizona. So bottom line, millennials will buy more, they'll buy cheap. Urban suburbs will be a big draw thanks to millennial demand and their penchant for living near restaurants. Home prices will move up just a tad bit, and buyers will see fierce competition, but only at the entry level. That, in a nutshell, is the single family forecast for 2020 for you. I'll skip past that slide. And now, multifamily, or the apartment forecast. Let's first take a look at how apartments did last year. Remarkably consistent, up 3%, fundamentally sound, no red flags. Well, it sounds like either the apartment lobby paid off Yardi Matrix or the apartment industry actually did really well in 2019. You decide. Now for 2020, let's ask Stephen Guggenmoss, who works for a quasi-government agency, Freddie Mac. He thinks more of the same in 2020. Stability, growth, robust rentals, strong construction. I think he may be right. Here's a quick video clip from commercial big dog CBRE. I play their 1 minute market outlook clip every year simply because I think Richard Barkham has such a cool British accent. Could have been James Bond in 2020 if he was a little less white or a little less male, if you know what I mean. Have a listen.
What do we think for the outperforming multifamily sector? We actually think a mild slowdown in apartment demand as a result of slower economic growth. We see that millennials will continue to move into home ownership, albeit at a modest pace due to affordability issues. We see the new supply that's coming online nearing its cyclical peak in 2020. In 2020, we think that permits and starts will fall, but we don't think deliveries will fall either. CBRE research predicts that multifamily completions will total 280,000 units in 2020. Rent control will continue to play a bigger role in the marketplace.
So as he said, you looked at the chart, deliveries at 280,000 and demand very close to 280,000, a little bit lower than that. So you might see a little bit of a slowdown in the Class A market as a lot of this new supply comes in, but Class B and Class C should do quite well in 2020 for apartments. Okay, so here are the two bread and butter multifamily graphs. The one on the left shows that rent growth is strong. So you see this? This is 3%. So you kind of see all of them, you know, they had this crazy 2015, which was just nuts. And then all the new supply came in it, and everything that was Class A and B got hammered. The Class C, which is basically workforce housing, did well. And then you had a little bit of an upward curve, and now things are kind of going down to about 3%. Historically, apartment rents have been at 2. So we're still moving towards that mean, and we're not quite there yet. What's interesting is the ultra hot Class C market or workforce housing market has done really, really well. Now, on the other hand, Class A, which is new construction, really got hammered in 2017, but since then has seen a very significant pickup. Now let's look at occupancy. Well, there, Class C still has an advantage, even though occupancy has dropped from its peak here of 96% to about 95.4%, Class C still needing A and B. Though once again, I'm impressed that Class A is showing an uptick in occupancy, even though they're increasing rents faster than they were a couple of years ago. So I guess people do want to live in new, nicer looking apartments. Who'd have thunk it? Overall, these are very strong occupancy number. These are very strong rent numbers. So that's the apartment picture for you. Much the same as 2019, another strong year, though definitely with slower rent growth than we've had in 2019. Okay, time for the Fight Club. Best cities in the US for real estate in 2020. I'm going to give you separately single family, multifamily, and new development. Let's take a look. First, oops, came one more time. Let's start with the top 10 single family growth markets for 2020. You'll note that I'm actually not a fan of most of them. I'll give you my favorites in a minute. And this data is coming from Realtor.com, which publishes a list in publishes a list every January. At 10 for the second year in a row is Memphis, Tennessee. Not my favorite market, but it does have some good bargains. Just know that it's a pretty rough market. At number 9 is Charleston, South Carolina, a market that's developing quite a bubble. Expect prices to go up for a bit, but the prices are definitely unsustainable in Charleston. So it's a great momentum market, but if it starts to fall, get out. North Carolina is doing well as a state, and Winston-Salem is an inexpensive North Carolina market, but I'm not impressed by this market's fundamentals at all. So I wouldn't be jumping on the next plane. Colorado Springs, unfortunately, is quite expensive. You see the prices here, but doing well because of all that money flowing in from Denver. Once again, this market appears to be forming a bubble, so be careful. Rochester, New York shows up in multiple lists. And if you must continue to invest in the Northeast, this market might be decent. It's definitely not overpriced. I'm not impressed by Columbia, South Carolina, but Chattanooga, Tennessee is another matter. This modestly priced market has decent income, decent population, decent job growth, and it's close to Nashville, which is a very powerful new economy. Tucson is one of my favorite markets in the list. With Phoenix becoming a world-class tier 1 market, Tucson is where a lot of the smart money is going, including us. We bought a property there 10 months ago. Let's just say the investors are quite happy. The job growth and population growth are not very impressive, but the population growth in particular is showing a strong upward trend in the last year and a half. This is a strong momentum pick and one that nearly got my pick as the top pick in 2020. A surprise in the list is McAllen, Texas. Its weak population growth means that there's a big question mark over its ability to sustain price growth. Not a no from me, but a big maybe. At number 1 is a market that should absolutely surprise no one. Even though no major real estate analytics company mentioned it in 2018 and 2019, yours truly picked it in this presentation, both in 2018 and 2019 versions of the presentation, and it is Boise, Idaho. Spoiler alert, I will not be picking it again this year. And there's no doubt that this is a very strong growth market in the short term, but I see severe pricing bubbles clearly developing here. So be careful. I think momentum will carry Boise for the next 2 years, but there's no doubt that the city is developing a pricing bubble at this point. Okay,
hey, Neil, if I can, I have a quick question for you. Like you get encouraged everyone else to ask questions. How do you protect yourself against a price bubble like that? If you see obviously indicators showing a really strong potential market, what kind of things do you do to prevent from getting caught up in that bubble?
Well, the first thing is that do not get so, number one, would I invest in Boise? Yeah, if I lived in Boise, I'd invest there. But understand that when a city develops a bubble, prices can crash very quickly, right? So Denver, Boise, these are cities with bubbles, but they may not crash for a while because the momentum is strong. Boise's job growth is very strong. So the honest answer to that question, and maybe I can give you a 30-second demo, is you got to buy software, right? If you're spending hundreds of thousands of dollars, what's the harm in paying $1,000 a year for this excellent software, Local Market Monitor? I'm not affiliated with them. But when I go in, I look at Local Market Monitor and, oops, log in. There we go, submit. Uh-oh, problems. Let me see if I can figure out how to log in. Whoops, for the moment, it looks like I can't log in, but here's what it looks like. When you log into Local Market Monitor, you can pull up Boise, you can pull up any other city, and what you'll notice is it tells you how much higher their home prices are compared to their income price. So it has two graphs. One is the income price, the price that people can afford to pay, and the other one is the price that people are paying. I can tell you for Boise City, the two bars are very separate. That's not good. That's a bubble. That's proof of bubbles developing. So what I tell people is it may be worth your while to pay $1,000 to Local Market Monitor and look at their reports and their investment scores rather than just guessing. These reports that Local Market Monitor provides used to cost $30,000 in the 80s, and now they're actually much more real time, and now they cost $1,000. What makes more sense? You know, paying $1,000 now, or paying tens of thousands of dollars, or losing your property simply because you didn't do the math? That would be my answer. Pay for the data. It's out there. There's another website called housingalerts.net that is equally good as Local Market Monitor. All right, so let's take a look at multifamily. Those of you that are interested in apartments, right? This Yardi Matrix is the best place in the US for to understand how apartments are going to do. Atlanta, Georgia, right, is in the list and has stayed at around 13 for the second year in a row. It's got strong population growth and very, very high affordability. This is not a market that's getting very expensive, so it's likely to remain strong for many years. Now, the big trend in this list is that the list now, this year, only has one city in Texas and one in California. So those two blockbuster states, the big states, seem to be slowing down a great deal, including Dallas, which has been up at the top of this list for a long time. It's not even in the list this year. So the growth is shifting to North Carolina and Arizona, and also some surprising states like Tennessee and Indiana, and even Pennsylvania. While some of the expensive stalwarts have managed to hang in this list because of decent job growth, they may not be in here longer. So moving on beyond Atlanta, we see the twin cities of St. Paul and Minneapolis. Now they're expensive with low cap rates, so you may not get much cash flow. So I'll move on to Philadelphia. Philly has lost population for decades, but there's no doubt that this city is now set for somewhat of a comeback. Strong rental market forecast for the next 3 years in Philly. Another market with below average job growth and below average population growth is Indy, but it's definitely showing some signs of life recently. So if you live in Indy or close by, you might want to look at it. There is absolutely no danger at all that the next entry in our charts, Charlotte, is going to drop off this list. Oops, not Portland actually. I'm going to go back. I forgot a piece. So at number 9 and number 8 are Portland and Austin. These are stalwart cities. They've been in this list for years and years, but finally I expect them to drop off the list, even because they keep getting more and more expensive every single year. So while Austin and Portland have both been at the top of this list, they are slowly making their way down. There's absolutely no danger that the next entries in our list, Charlotte, is going to drop off for a while. Very strong income growth, very strong job growth, and insanely strong population growth are a big trifecta that is going to power Charlotte on for many years. Expect a very strong rental market. Sacramento is hot, but not as hot as the last 2 years. If you're in California, you might want to look at it, but be aware it's on its way down the list. I still might see it in the list next year. Another star in this list is Raleigh, North Carolina. I don't know what the politicians in North Carolina are doing, but they really deserve a pat on the back. Very, very strong market. At number 4 is Inland Empire in California. This market is also cooling, but very slowly. I do expect to see it in the list next year. So if you're in California, take a look at Riverside and the Inland Empire. Number 3 is Nashville. It's done extraordinarily well. But I'm wary of this market because it's seen such huge price increases. Local Market Monitor shows a bubble developing in Nashville. So it's a risky bet at this point, unless you like short-term momentum plays. You want to do a flip and you live in Nashville, be my guest. You want to do a 5-year or 10-year bet, be careful. At number 2, we have Las Vegas, Nevada. This is forever a momentum city. In the last 2 years, we've seen absolutely monstrous home price increases. I would be careful buying in Vegas for the long term today. But if you're a momentum player, there's no doubt that the force is with Las Vegas today. We are much more bullish in the long term on the winner, Phoenix. This market has extremely strong momentum because of spectacular price increases in the last 3 years, but it has very strong job growth and very strong population growth, which is why we also think that it continues to do well in the long run. This is why we're building in Mesa, which is the second largest city in the Phoenix metro. It's about 20 minutes away and not as expensive as Phoenix itself. So that's our list for those of you that are interested in investing your money into apartments. And I'm going to go through this very fast because very few of you in this list, in this particular webinar, are interested in multifamily development, which is something that I do. I want to point out again, Phoenix is in the list, Las Vegas, Nashville. So the list looks actually fairly close. And you've got Raleigh, North Carolina in the list as well. So 90%, oops, what happened here? 90% of the list is actually the same. So almost looks like the list is kind of rejiggled around. But if I was going to do multifamily development today, I probably wouldn't do it in Phoenix. I'd probably do it on the outskirts of Phoenix like Mesa, but I would certainly consider both Raleigh and Charlotte for new construction. So done, except for my last bit, which is my picks for 2020. I pick one market that I see as having underperformed so far, but I think that it's got a bright future. And then I pick the best market in America for 2020. So let's start with that underperforming market. But for those of you that are interested at this point in, actually you like my database stuff and you like the videos and the articles and the trends and the, all of these reports and a huge toolkit, here's a toolkit that is on my website and you can get access to it. I update it once a quarter with reports, analytics, videos, interesting videos. And then halfway down the year, I actually do a mid-year update of this presentation. So if you're interested, grab your phone and text the word RE Toolkit, that's one word, no space in the middle, to this number 44222. Once again, text the word RE Toolkit to the number 44222. And you'll get access to all of my presentations and you get notifications when they're updated. Last time, RE Toolkit to the number 44222. All right, let's pick my top pick for an underperforming market this year happens to be San Antonio, Texas. So it's only underperforming compared to Dallas and Austin and Houston, the larger Texan markets. But I do think that this market is now finally ready for prime time, and I think it'll do really well over the next 2 to 3 years. San Antonio, Texas, check it out. And now, drum roll, my pick for the best city in the US for real estate in 2020 is, for the first time in years, it's a tie. Raleigh, North Carolina, and Charlotte, North Carolina are photocopy cities. When I look at their population growth, their job growth, their income growth, their home price growth, their crime reduction, in every way, these two blockbuster cities are doing incredibly well. Home prices are still low enough for investment grade opportunities, and you get cash flow as well. But what I'm excited about is I think that both of these cities are on a 5 to 10 year run. So you might get both cash flow and appreciation. Raleigh and Charlotte, the core cities, may not have enough cash flow. For Raleigh, you might have to look at Durham. For Charlotte, you might have to look at outskirts, maybe 20 miles away from the city, and you should be able to get good properties with good cash flow. So check out these two incredible markets for 2020 if you're looking to invest in real estate. And then that's my presentation. I'll take questions. Feel free to plug them in. For those of you that like what I do and you'd like 50 webinars a year, all of them free, that are deep dives into various aspects, taxes, asset protection, Airbnb, securities laws, opportunity zones, you name it. There's so many different webinars that we do. Bookmark multifamilyu.com. These webinars are free, and we do not sell your data to anyone. That's our show, Scott.
Good. Yeah, thanks, Neil. Great information as usual. I had a couple people just requesting some of the information on the different deals. I would say maybe the easiest, this slide right here has got your phone number and your email.
Exactly. Yep.
Just email Neil and ask him specifically for what you're interested or what you're looking at as far as information-wise or about a potential investment, and he can get that sent to you. We don't have a way to, well, we're not permitted to have to share everybody's information, I should say, with the group and on a mass email list, but just reach out to Neil directly. And certainly, like you said, growcapitalists.com for a lot of other really good information too on multifamily. Somebody did have a question whether or not the session's being recorded. It is, and we will send the recording out as well to everybody who's on here. So you'll be able to go back and re-listen to it, maybe revisit it towards the end of the year and see if Neil was right on his 2 picks. But like I said, Neil, you mentioned you're going to kind of update this throughout the year, correct? Or maybe halfway point, take a look at it again.
So at the end of Q1, we'll update the toolkit. So if you subscribe to that toolkit on our website, you'll get an email showing all the updates that we did. And then in June, we update the presentation. So we kind of say, okay, well, here's what we said at the beginning of the year. How many of these did we get wrong? How many did we get right? And then and then of course, you'll probably see me here back at Advanta a year from now with my 2021 presentation. That'll be a year from now.
Yeah, absolutely. So again, if anyone has any questions, here, get them type in here. We have a couple minutes here to get those answered. Trying to think maybe some other things that we touched on in questions. Just now, I know you focus primarily in multifamily, Neil. Do you also do some single family investing on your own as well?
I do, and I actually continue doing that. So my single family investments are in several different states, and I don't find anything wrong with single family investment. It doesn't scale well, and I get paranoid with the fact that either you have 100% occupancy or you have 0% occupancy in single family. So that messes with my head quite a bit. Whereas with multifamily, if you lose 10 tenants on a 250 unit, your occupancy is only down 4%. So also, I'm data driven, as you can tell. In 2008, single family lost 29% of value nationwide. Some cities went as low as 60%. You'll be interested to know that apartments lost 8% of value. 8%, not 29. Also, how many years did you think rents were down for apartments? 1. So 2008, rents were positive. We actually had rent growth. 2010, they were positive. We had rent growth. We lost between 2.5% and 5%, depending upon which website I picked the stats from. That's it. That's all the rental losses we had in apartments. So as an asset class, it's much more stable. Also, in terms of defaults, at no point in 2009 did defaults for apartments cross even 5% of the defaults that were happening for single family. Today, the defaults for apartments are 1/50th. That's 2% of single family defaults that happened in 2019. So because I'm risk averse, I tend to gravitate towards multifamily, but single family has its own advantages. The biggest advantage there was 1031. Finally, in 2019, we solved that because we are now offering 1031 eligible multifamily projects.
That's a great answer. And maybe looking at some, trends, or whatever, obviously it seems like in this country there's such a move towards renting versus owning, and I think that's helped fuel a lot of the multifamily growth and those opportunities. Do you see that trend? Is there an end point? Do you think the titles turn a little bit and people will go back to becoming, more of a homeowner society, or is this a generational thing that we're seeing that may continue on?
It is actually unquestionably a generational thing, and if I can take 30 seconds, because this is actually something that I'm very passionate about. I have research documents that are on that toolkit page, and I'm going to see if I can actually quickly pull one up. And what, you know, these research documents talk about the home ownership rate in the United States. And the most famous study of all is by two academics called Myers and Lee that come from the University of California. And I want to actually show you a very quick graph of their answer to this question. These are people that are not politically inclined, and what they're saying is, okay, here's what we think the homeownership rate's going to be. So let me scroll down. This is their prediction, and as you can see, their prediction of homeownership rate for the next until 2050 is either horrifically bad, and this would mean a worldwide depression if it happens, the likely declines, and then the bullish case. Did you notice that all three cases, including the bullish case, are for homeownership rates to decline over the next 30 years? So, you know, this is really bullish. I can't imagine this happening, but if it happens, they still decline from where they are today to about 64% to about 60. Well, a 4% decline in the homeownership rate means that magically we need to find from somewhere 8 million apartments. I'm telling you, we're not building enough. We built 280,000 units in 2019, which was the peak of this cycle. Where are we going to find, even if we assume that half of those people go and live in mobile home parks or with mom and dad, where do we find 4 million apartments? We can't build enough of them because the cost of construction is so high. So this is a 30-year trend. I encourage those of you that signed up for my toolkit to read this entire study and blow your mind as to how America will turn into renter nation and landlord nation in the next 3 decades.
Good. Thanks for answering, Neil. We're just about out of time. I'm going to pull back the presentation, I think, here in just a second. Yep. Or maybe if I can't, maybe not, we'll just stop it here too. But at the end, thanks everybody for logging in. Neil, thank you very much again for your time and coming on. And we definitely will look to have you back on either maybe later this year, or definitely at least at the beginning of next year when it comes to real estate trends for 2021, which I can't believe we're that far into the year. It seems like the year 2000 was just a couple days ago, or a couple years ago. Here we are at 2020 and moving on beyond that. So again, thank you for coming on. I really appreciate your time, and everyone who listened. Like I said, we will send out that recording. And just reach out to Neil. Any questions you have about what he does and Grow Capitus or Multifamily U. Neil, you want to give your phone number out in an email one more time?
Yeah, I actually, hang on for just 10 seconds. My phone number is 510-367-1510. My email address, and I use the Irish spelling for my email address. It is, and I'm going to have it, oh, actually, my screen's not shared anymore. It's Neal, N-E-A-L, at Grow Capitus, that's G-R-O, no W, G-R-O, Capitus, C-A-P-I-T-U-S.com. And the website that has all those awesome webinars is multifamilyu.com. That's multifamily followed by the letter u.com.
All right, Neil, thank you again, and we'll wish you well, and thanks everybody again for attending.
Thank you. Have a wonderful day, guys.